Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Today, we're embarking on a deep dive into a stack of compelling sources from CNBC, Reuters, Yahoo Finance, and Investopedia. Our mission, as always, is to cut through the noise, extract the most important nuggets of knowledge, and connect the dots so you can quickly grasp the big picture and leave feeling truly well-informed. We've got some surprising facts and fascinating insights waiting for you as we explore a market grappling with unexpected resilience, intense political crosscurrents, and some really dizzying innovation. So let's kick things off with the U.S. economy. Despite all the persistent, noise about tariffs and inflation, the economy seems to be standing remarkably firm, actually pushing market records higher. What's a core takeaway for you right now from these initial numbers?
Well, what's truly striking is how these robust economic signals are unfolding against this backdrop of ongoing policy uncertainty. It really makes you wonder if we're witnessing an economy that's fundamentally built to absorb these pressures, or, if there's maybe a quieter storm on the horizon. Our sources, like the CNBC Daily Open, really highlight this surprising strength. They're suggesting the U.S. economy is still, quote, built on rock-solid data.
Right. And the market performance certainly backs that up. We're seeing the S&P 500 up, over 0.5% for its ninth record close of 2025, hitting 6,297.36.
Ninth record, yeah.
And the NASDAQ composite advanced even further, up 0.75%. That's its 10th close this year at 20,885.65. What I find interesting is that investors seem to be taking comfort in these underlying fundamentals. It's not just speculation or fear driving things, it seems.
Exactly. And beyond just the headline market figures, we're seeing some really strong economic indicators, too. CNBC points to stronger than expected June retail sales, which is, a clear sign that consumers are flexing their spending muscle, as they put it.
Spending muscle.
And weekly jobless claims actually dropped below forecasts. So this resilience from the U.S. consumer pushes back on recession fears, which is a pretty powerful signal.
But there's always a wrinkle, isn't there? We've got the Trump administration's shifting trade winds and that looming August 1st tariff deadline.
Right, the deadline.
And CNBC cautions that economic data is, quote, always a step behind, meaning the full impact of these tariffs might not be immediately visible. It could be muted at first because, businesses and consumers are stockpiling, maybe foreign exporters cut prices, inventories clearing out. It's like a quiet before a potential ripple effect.
Yeah, it's that contrast again, robust signals playing out against this policy uncertainty. Are we in the eye of the storm, or is the economy just fundamentally built to withstand it, like that CNBC source suggested, built on rock-solid data?
Okay, now let's shift gears to something that's creating a lot of friction.
Yeah.
The Federal Reserve. Chairman Jerome Powell is under, immense pressure from the White House. He's facing scrutiny over both interest rates and, maybe surprisingly for some, the Fed's headquarters renovation project. What's driving this dual front attack? What does it tell us?
Yeah, the headquarters renovation defense is quite a story. It's reported across CNBC and Yahoo Finance. Apparently, Russell Vought, the White House OMB director, that's Office of Management and Budget, accused Powell of grossly mismanaging the Fed and orchestrating an ostentatious overhaul. Vought specifically called out things like luxurious extras, private elevators, VIP lunchrooms, rooftop gardens, that sort of thing.
Okay, so quite the accusation.
Yeah.
And Powell's response, as detailed by both Yahoo Finance and CNBC, was pretty firm, right?
Very firm.
He stated, "We take seriously the responsibility to be good stewards of public resources, directly denying those luxurious extras." He clarified the buildings genuinely needed significant structural repairs, saying they hadn't been renovated since the 1930s.
A long time.
Right. And he also stressed that elements like new water features and VIP dining rooms were either eliminated or just inaccurate media reports. Plus, the project has had approval from the National Capital Planning Commission since 2021. So, a direct rebuttal to the luxury claims.
It definitely highlights the political heat on the Fed. But what's truly fascinating is the interest rate divide itself beyond the building spat. Yahoo Finance and Reuters report that President Trump is, quote, furious at Powell's refusal to lower interest rates. He even floated the idea of firing Powell, though he did qualify that, said it was highly unlikely unless he has to leave for fraud. Still, that's a significant statement from a president about a Fed chair.
And this fury seems to have created a clear split within the Fed itself, almost like two opposing camps. So on one side, the doves, those advocating for lower rates.
Yeah.
You've got Federal Reserve Governor Christopher Waller. He made his strongest call yet for a rate cut in July. He's pushing for the policy rate to be 3%, which is 125 to 150 basis points lower. That's a 1.25 to 1.5 percentage point cut. Pretty substantial.
It is.
Waller argues that tariffs are just one-off price increases the Fed can kind of look through, and that despite appearances, the job market's actually showing some downside risks.
But then, conversely, you have the hawks, those leaning against a cut. People like Fed Governor Adriana Kugler and New York Fed President John Williams argue against cutting in July. Reuters and Yahoo Finance both point to their concerns about inflation pressure from tariffs. They note goods inflation is already rising, and businesses haven't yet fully passed on these costs.
Okay.
So they foresee inflation potentially increasing in the second half of the year. It's a genuine debate happening inside the Fed, driven by different interpretations of the data and the risks.
Right. So given this uncertainty, particularly around Powell's future maybe, Reuters highlighted some intriguing hedge fund strategies. How might they play a potential Powell departure? For instance, RBC Blue Bay Asset Management would apparently buy 2-year U.S. Treasuries, sell 30-year Treasuries. So for you, the listener, that means they expect short-term bond yields to drop.
Right. Front-end yields down.
And long-term yields to rise. They anticipate undermined Fed independence, leading to increased medium-term inflation risks.
Yeah, and we see other nuanced plays, too. For Asset Management, they specialize in convertible bonds. They prefer short-dated ones, like a 2026 bond over a 2030, based on its conversion price. They're expecting an inflationary result if rates are cut. And then Coloma Capital Futures would look to sell the dollar against a basket of currencies. They're anticipating a narrower interest rate difference and pressure from U.S. debt and taxes. And UBP Investments, looking at Japan equities, would short Japanese exporters, betting against their stocks, expecting the yen to strengthen and most Japanese stocks to fall. It just shows you the layers of thinking, how different players position themselves for these potential high-level shifts.
Okay, let's unpack this a bit more. It's clear the political pressure on the Fed is immense, right? But that internal debate over the economic data, the tariff impact, it highlights the complexity. For you, the listener, understanding these different perspectives is really key to anticipating potential market movements. So with all that strategic maneuvering around the Fed, let's pivot and see how individual companies are navigating this landscape. Because, ultimately, the earnings reports give us a real-time look at who's winning and why.
Yeah, and that brings up an important question. In a market fueled by strong earnings and consumer spending, but also these policy debates, how much can these individual company stories impact the broader narrative? It's not just about the big names. It's about the patterns these successes reveal, like the ability to cut tariff costs maybe, or capitalize on specific niches. That's where the real insight often lies.
That's a crucial point. Let's look at Netflix. According to reports from Yahoo Finance and CNBC, they really topped Q2 earnings expectations. Revenue up a significant 17.3% year over year. Pretty impressive.
Very solid.
They even updated their full year 2025 revenue forecast, citing a weaker dollar, healthy member growth, strong ad sales. Netflix stock itself is up nearly 43% in 2025. That makes it the best of the Magnificent Seven stocks right now.
Leading the pack.
Yeah. Their ad-supported tier alone hit 94 million global monthly active users. Ad revenue expected to double to $3 billion in 2025. And they've got a strong content slate coming, new seasons of Wednesday, Stranger Things, Squid Game. Plus, interesting note, they're prioritizing building over buying legacy media networks. No big M&A plan there.
Okay, shifting sectors now. Johnson & Johnson saw a surprising rally. CNBC reported its shares climbed over 6% after beating earnings and revenue estimates and significantly raising guidance. What's particularly interesting here, and a great example of those patterns you mentioned, is they cut previous estimates for costs related to new duties. That's a positive sign for investors, shows they're managing it.
That is interesting, yeah.
They also shared promising results for new cancer treatments, including a bladder cancer breakthrough potentially worth $5 billion in peak sales. Management has as a lofty goal to be the #1 oncology company by 2030, with sales of more than $50 billion.
And then there's Opendoor. Yahoo Finance tells us their stock jumped another 10.8% on Thursday. That brings its one-month gains to nearly 200%.
200% in a month.
Wow. Yeah. Apparently fueled by retail enthusiasm and this bold thesis from investor Eric Jackson, who believes it Could be a 100-bagger over the next few years. Serious optimism for a real estate tech platform.
Speaking of optimism, let's touch on some quick takes from Kramers' lightning round on CNBC. For ConocoPhillips, he just said, buy COP, we should be in ConocoPhillips. For AMD, advanced micro devices, a bit more circumspect. I don't know, but it's going in the right direction.
Okay.
And for Chemico, the uranium play, he likes it. I like CCJ. I just think that this is a winner. So some straightforward thoughts for you to consider there.
Also happening today, Investopedia confirmed the trade desk, ticker TTD, is set to join the benchmark S&P 500 index.
Yeah.
News of its inclusion already lifted shares by about 8%. That's usually seen as bullish, right? Because index funds have to buy it.
Exactly. Automatic buying pressure. And we're seeing some M&A chatter in the railroad industry. CNBC and Yahoo Finance reported Union Pacific is in early stage, talks to potentially buy Norfolk Southern. Norfolk Southern shares are already up 4% after hours, 15% year-to-date on this news. The market clearly likes the idea of consolidation in that sector.
And for a broader market sentiment check, CNBC quoted Interactive Brokers founder Thomas Peterffy. He sees no dark clouds on the horizon and expects the rally to continue for the next 2 or 3 years.
Quite bullish.
Yeah, and his company's shares, Interactive Brokers, are up 49% in 3 months. So a strong vote of confidence there. Plus, keep an eye out today. Regional banks are reporting. American Express, Comerica, Huntington Bank shares, Regions Financial, Truist Financial. Many of them have seen significant gains recently, too. Now let's broaden our view again. Because while the U.S. economy shows this surprising resilience, the global picture adds fascinating layers. Here's where it gets really interesting. You can see how global events and domestic policies, from G20 talks to local permitting, they all weave together into this complex economic fabric. How these pieces interact, well, that will define market narratives for months to come.
Indeed. So, starting with global finance leaders. According to Reuters, they're approaching consensus on global challenges at the G20 meeting down in Durban, South Africa. This is despite the overshadowing U.S. tariff tensions. Notably, U.S. Treasury Secretary Scott Bessent was absent, which raised some questions, though the U.S. did engage in the discussions. South Africa, as the host, is actively promoting an African agenda focusing on the high cost of capital and climate change funding. Critical issues for developing nations.
Okay. Then we shift to Japan. CNBC reports core inflation there eased a bit to 3.3% in June. That's down from a 29-month high of 3.7%. Race inflation is also showing signs of easing. But it's worth remembering, Japan has the highest debt-to-GDP ratio in the developed world. Japanese bonds are definitely in focus ahead of their election this Sunday. Could impact policy,
Definitely something to watch.
Yeah.
And wow, this is a striking display of resilience. Israel's stock market. CNBC details it's at a record high. It's actually outperforming the entire Middle East despite, well, multi-front wars and troop mobilization. It's up over 200% from its lows back in October 2023.
Incredible. What's driving that?
Apparently significant foreign investment, like $2.7 billion just this year so far, and renewed investor confidence after that 12-day conflict with Iran. Plus, their high-tech sector is a huge engine, 20% of GDP, 56% of international exports. The Israeli shekel even gained nearly 7% against the dollar after the Israel-Iran conflict, and the OECD is forecasting impressive 4.9% growth for Israel in 2026. Just remarkable, given the circumstances.
Turning to energy markets. Bloomberg highlights oil is holding gains near $70 a barrel. Seems supported by strong summer demand for diesel.
Summer driving season.
Yeah. Right. The EU's 18th sanctions package on Russia includes a lower price cap for Russian crude and curbs on their petroleum fuels. There are also some concerns about potential impacts on diesel supplies to Europe, especially since an Indian refinery, partly owned by Russia's Rosneft, was blacklisted. Somebody keep an eye on there.
And back in the U.S., on the domestic policy front, CNBC outlines the Trump administration's One Big Beautiful Bill Act. It includes a new $250 visa integrity fee for non-immigrant visitors. Cannot be waived, apparently.
Yeah.
Furthermore, the administration is targeting solar and wind projects with tighter federal permitting. Interior Secretary Doug Burgum is now making the final decisions. The stated goal is to end preferential treatment for renewables and level the playing field for coal and natural gas, though critics are calling it politically motivated obstruction.
And now for innovation, which truly shows the future taking shape right now. From AI to the stars, new tech, new sectors, evolving rapidly, attracting significant investment. What's the biggest takeaway for you here? What's truly poised to redefine things?
Well, if we connect this to the bigger picture, what we're seeing isn't just cool tech advancements. It's a significant shift in where investment is flowing and how regulators are engaging. The convergence of AI, blockchain, space exploration, it could fundamentally redefine entire industries, maybe even create new asset classes. So this raises an important question for all of us, for you listening. How quickly will these emerging trends become the mainstream norm for investors? And how do we prepare for that shift?
That's a huge question.
Yeah.
Starting with AI, the CNBC Daily Open recently highlighted how AI-generated music is going viral, like this psychedelic rock band called the Velvet Sundown. Over 1 million monthly listeners on Spotify.
Ah,
Turns out it's primarily the work of generative AI.
really? Wow.
Yeah, prompting some serious questions for the traditional music industry about IP, creativity.
And then you hear from someone like Nvidias CEO Jensen Huang. His vision for AI, reported by CNBC, is really thought-provoking. He said if he were a student today, he'd focus on physical sciences, not just software. He sees physical AI as the next wave.
Physical AI.
Yeah, after perception, generative, and reasoning AI. This physical AI, he argues, needs to understand physics, friction, inertia, cause and effect. He thinks it'll lead to digital robots, robotics for plants, factories, fundamentally addressing labor shortages. It's a vision bridging the digital and physical.
Okay, switching gears to crypto. Yahoo Finance detailed what they're calling the stablecoin revolution. The U.S. House just passed the Genius Act. It's a stablecoin bill, now heading to President Trump's desk. Seen as a major victory for the crypto industry.
Big step for regulation.
Yeah, it establishes the first federal framework for dollar-backed stablecoins. Interestingly, it also bans central bank digital currencies and assigns oversight to either the SEC or the CFTC.
Yeah, and what's particularly notable here, as Yahoo Finance points out, is that Trump himself is deepening his financial involvement. He's got this new crypto startup, World Liberty Financial, which launched its own US dollar-pegged stablecoin, USD1. This move is expected to unleash a wave of new stablecoin entrants, from traditional firms to big banks like JP Morgan, Citigroup, maybe even retailers like Amazon and Walmart. Proponents see stablecoins as, a haven from crypto volatility, offering near-instant settlement, easier cross-border transactions, wider access to the dollar.
But there are risks, too.
Definitely. Concerns about panic runs among investors still linger. Meanwhile, just for context, Bitcoin's up 86% in the past year, Ether up 4% year to date.
And finally, let's talk space. The space sector. CNBC reports it's really heating up. Attracted $3.1 billion in investments in Q2 alone. That makes it the second largest quarter on record, despite all the global uncertainty.
That's impressive.
Venture capital firms contributed a huge chunk, 77% of 2025 funding so far, driven by interest in defense opportunities and just better market sentiment, it seems. U.S. firms absorbed 70% of that Q2 funding, already surpassing their total 2024 investment, even with some federal contract and NASA budget cuts.
Absolutely. And we're seeing more companies go public. Rocket maker Firefly Aerospace filed for an IPO on NASDAQ. Voyager Technologies recently went public. Shares soared over 80%.
Wow.
Even SpaceX is reportedly looking at fundraising plans that could push its valuation towards $400 billion. And they agreed to invest $2 billion in xAI, the maker of the Grok chatbox. And get this, space startup, Varda clinched $187 million to make drugs in space.
Manufacturing in space.
Yeah. Plus other news nuggets like Trump naming Sean Duffy interim NASA chief, Macron urging UK space investment, new discoveries from the moon and black holes. The scope is just huge.
Now, we need to touch on some significant political and legal headlines, specifically surrounding the Jeffrey Epstein case. This is a deeply complex and sensitive area. What stands out here is the intense political and legal maneuvering around these decades-old events and the direct impact it's having now. So, just want to be very clear up front. We're presenting these reports from our sources, primarily CNBC and the Wall Street Journal here, as they are, without endorsing any particular viewpoint. Our aim is simply to ensure you're fully informed on the factual content provided in these reports.
Right. It's important context. So first, the calls for transparency. President Trump announced he had asked Attorney General Pam Bondi to seek the unsealing of grand jury testimony related to Epstein's criminal prosecution. However, the White House also stated Trump would not recommend a special prosecutor for the case. This is despite growing calls for one in Congress and from some influential conservative voices.
Then there's the body letter controversy, reported by the Wall Street Journal and picked up by CNBC. The Journal reported a, quote, body letter bearing President Donald Trump's signature, was included in an album of letters Epstein received for his 50th birthday back in 2003. The letter reportedly contains several lines of typewritten text framed by the outline of a naked woman, with Trump's signature below her waist. Trump denies writing the letter or drawing the photo, calling it a fake thing. He's threatened to sue the Wall Street Journal, its parent company News Corp, and Rupert Murdoch over the report.
And then, adding another layer, CNBC reported the Justice Department summarily fired Maureen Comey. She was a top prosecutor who had been part of the teams that prosecuted both Epstein and Ghislaine Maxwell. Her email to colleagues afterwards was quite pointed. She stated, "If a career prosecutor can be fired without reason, fear may seep into the decisions of those who remain," adding, "Fear is the tool of a tyrant, wielded to suppress independent thought." Strong words.
Very strong words.
And President Trump's own stance on this has been quite forceful. He's lashed out at calls for more transparency about the Epstein case, calling it a scam and a Jeffrey Epstein hoax whipped up by radical left Democrats, according to reports. He maintains he cut ties with Epstein years before that 2008 sex crime plea deal. So again, presenting the reported positions and events factually.
Okay, what a whirlwind of headlines and insights today. From record-breaking stock markets and those fascinating internal debates at the Fed to the cutting edge of AI and the dynamic growth of the space sector. We've covered a lot of ground today in our deep dive into the major financial magazine headlines. It truly underscores how interconnected global economics, technology, and, yes, policy really are.
Indeed. As we've seen, the data and narratives are constantly shifting. That surprising resilience of the U.S. economy, the ongoing policy challenges for the Fed, the rapid pace of innovation in areas like stablecoins and space, these are all critical threads for you to follow. I guess the question for you to mull over now is, which of these underlying forces do you believe will truly shape the market's next major inflection point?
That's a powerful thought to take into your weekend. Thank you for joining us for this deep dive. We hope you feel even more well-informed than before. And with that, we'll see you all Monday morning with new headlines from major financial magazines.